Imagine waking up one morning and realizing the money you earned last year is quietly working for you, even while you slept. That's the power of investing, and it's why today we were talking about where beginners should start and what they really need to know. Whether you have $50 or $5,000, whether you're fresh out of college or mid-career, the fundamentals are the same. By the end of the next 20 minutes, you will know the exact steps to open your first account, choose investments that fit your life, and avoid the classic rookie mistakes that cost new investors time and money. Let's begin with a simple question. Why invest at all? If you leave cash in a checking account, it earns basically nothing, and inflation, now hovering around 3% a year, eats away at its value. History shows that broad US stock market indexes have returned about 10% a year before inflation, 6 to 7% after. Bonds and high-yield savings accounts offer lower returns, yet still beat burying money in the backyard. Compounding means even small amounts grow dramatically. $100 invested monthly at 7% turns into about $250,000 after 40 years. Time, not luck, is the real secret sauce. Before you chase returns, set clear goals. Ask yourself, what am I investing for, and when will I need the money? Retirement in 30 years. A down payment in 5. Kids' college in 15. The timeline guides how aggressive you can be. Longer horizons let you ride out market swings with more stocks. Shorter horizons require safer assets like bond funds or cash equivalents. Next, gauge your risk tolerance. Picture the market dropping 20% next month. Would you panic sell, feel uncomfortable but stay the course, or buy more? Be honest, you'll sleep better. Risk tolerance often lines up with age, but not always. Plenty of 20-somethings hate volatility, and many retirees happily keep a slice in stocks. With goals and risk in mind, decide who will manage the nuts and bolts. You, a robo-advisor, or a human advisor. Doing it yourself via an online brokerage, Fidelity, Schwab, Vanguard, Robinhood, take your pick, gives maximum control and minimum cost. A robo-advisor like Betterment or Wealthfront automates everything for an annual fee around 0.25% of assets. A full-service advisor charges more, often 1% or higher, but may be worth it if you need personalized planning and behavioral coaching. Beginners comfortable with apps often start DIY or robo, then graduate to hybrid help later. Now open the right type of account. For retirement, a workplace 401k or 403b is a no-brainer, especially if your employer matches contributions. That's free money. If you don't have a plan at work or once you want to save more, open an IRA. Traditional IRAs lower today's taxable income. Roth IRAs skip the upfront deduction but grow tax-free forever. If you're self-employed, look into a solo 401k or SEP IRA. For goals before retirement, say a house fund, use a regular taxable brokerage account where money can be withdrawn any time, but capital gains are taxed. Account open? Great. It's time to choose investments. Most beginners should start with broad, low-cost index funds or ETFs. An S&P 500 index fund instantly buys you tiny pieces of 500 leading US companies for an expense ratio under 0.05%. Add a total international stock fund for global exposure and a total bond market fund for stability. That 3-fund portfolio covers more than 10,000 securities worldwide, yet is simple enough to manage on your phone. If you prefer one-stop shopping, pick a target date retirement fund. Select the year closest to when you plan to retire, say Target Retirement 2060, and the fund automatically adjusts from mostly stocks today to more bonds as the date approaches. Expense ratios are a bit higher than single index funds, but still low, often under 0.20%. You might hear friends brag about individual stocks, crypto or options. There's nothing wrong with exploration, but treat it like hot sauce. A dash can spice things up. too much ruins the meal. A common rule is core and explore. Keep 90% of your portfolio in diversified index funds, and if you can't resist, use the remaining 10% to pick Tesla, Nvidia, or Ethereum. But be prepared for roller coaster rides. Let's walk through a real-world example. Meet Jordan, age 28, earning $55,000 in Atlanta. Jordan's employer offers a 401k match of 3%. Step 1, Jordan contributes 3%, about $1,600 a year, to capture the match. Step 2, Jordan opens a Roth IRA at Vanguard and sets up automatic transfers of $200 a month into a total stock market index fund. Step 3, Jordan builds an emergency fund so investing can continue even if the car blows a gasket. After that, any extra cash flows into the 401k up to the annual limit. Time required each month? Maybe 15 minutes to review balances and rebalance if stocks drift more than 5% from the target mix. What about someone starting later? Lisa is 45, with no retirement savings and a freelance income that swings wildly. She opens a traditional IRA and sets up dollar-cost averaging, $250 every Friday when she gets paid. Some weeks she adds more, some less, but money hits the market in regular intervals, smoothing volatility and removing the temptation to time swings. Let's pause for a quick jargon check. Stocks represent ownership in companies. Bonds are loans to governments or corporations. Mutual funds pool investors' money to buy many securities. ETFs are funds that trade like stocks during the day. Expense ratio is the annual fee funds charge. To keep more of your returns, aim for 0.20% or lower. Market order buys at the current price. Limit order sets a maximum you'll pay. Dividends are cash payments from profitable companies. And rebalancing means restoring your original stock-to-bond mix once or twice a year. Taxes matter too. Hold high-growth stock funds inside tax-advantaged accounts like IRAs. In taxable accounts, favor index ETFs because they rarely distribute capital gains. If you do sell, assets held longer than a year enjoy lower long-term capital gains tax rates. And don't forget tax loss harvesting, selling losers to offset winners and up to $3,000 of ordinary income each year. Fees and minimums are lower than ever. Most brokers offer commission-free trades and let you buy fractional shares, so $10 can purchase Apple or the S&P 500. Robo-advisors invest your spare change automatically. Acorns rounds up purchases to the nearest dollar and invests the difference. But low cost doesn't equal zero risk. When markets tank, as they did in early 2020, and again in smaller waves since, you must resist the urge to bail out. History shows the market's biggest up days cluster around its worst down days. Miss a handful and long-term returns collapse. Diversification extends beyond stocks and bonds. Real estate investment trusts, or REITs, add property exposure without buying a duplex. Treasury inflation-protected securities hedge rising prices. For the adventurous, small allocations to commodities or crypto can diversify, but only after core needs are met. Avoid common pitfalls. Chasing hot trends, meme stocks, get-rich-quick crypto plays often ends in losses. Paying high-expense active funds rarely outperforms low-cost indexes over time. Day trading taxes and stress frequently outweigh any gains. Leverage, like margin loans or options, magnifies mistakes alongside successes. Steer clear until you fully grasp worst-case outcomes. How much should you invest? A popular starting point is 15% of gross income toward retirement. If that feels impossible, begin with what you can and raise the percentage 1 point every 6 months or whenever you get a raise. Automate contributions, so investing happens before money hits checking, out of sight, out of mind. Rebalancing keeps your risk consistent. If stocks surge and your original 80-20 stock-bond mix drifts to 88-12, Sell a bit of stocks or add new money to bonds until you're back at target. Most custodians let you schedule automatic rebalancing yearly or quarterly. Stay informed without doom scrolling. Check reputable sources like Vanguard, Fidelity, or Morningstar for fund research. Listen to podcasts, Planet Money, Animal Spirits, or Bigger Pockets Money for balanced commentary. Ignore sensational headlines predicting imminent crashes or booms. No one rings a bell at the top or bottom. Insurance protects the plan. A single accident can derail investment goals. Make sure you have health, auto, renters or homeowners, and disability insurance. If someone depends on your income, term life insurance is inexpensive peace of mind. Let's address 3 frequent beginner questions. First, is now a bad time to invest? Every generation asks this. If you're investing for long-term goals, the best time was yesterday, the second best time is today. Dollar-cost averaging reduces timing risk. Second, how much cash should I keep? An emergency fund covering 3 to 6 months of essential expenses shields you from dipping into investments during downturns. Beyond that, idle cash loses to inflation. Third, what if the market crashes right after I invest? It might. History offers reassurance. Every US bear market has eventually been followed by a new all-time high. The antidote is diversification, time in the market, and sticking to the plan. As you grow comfortable, refine strategy. Use sector funds to tilt toward technology or healthcare if it matches your convictions. But keep positions reasonable. Consider a small cap index for extra growth potential. Explore Series I savings bonds for inflation protection up to $10,000 per person per year. Study tax-efficient withdrawal strategies long before retirement arrives. Finally, remember, investing is a journey, not an event. Celebrate milestones. Your first $1,000 invested, your first dividend reinvested, hitting a 5-figure portfolio, then 6. Share the learning. Teach a friend or child how compounding works. The habits you build today will shape financial freedom tomorrow. To recap the action steps: 1. Define goals and timelines. 2. Assess risk tolerance honestly. 3. Choose management style, DIY, robo, or advisor. 4. Open appropriate accounts, 401k, IRA, brokerage. 5. Fund regularly using automatic transfers. 6. Select diversified, low-cost index funds, core and explore if desired. 7. Rebalance annually and review fees. 8. Stay the course through market ups and downs. Take the first step this week, even if it's just opening an account and depositing $25. Then set a calendar reminder to increase contributions next month. In a year, you'll look back amazed at how far you've come. And in decades, you'll thank your past self for giving compound growth plenty of time to work its quiet magic. That's everything you need to start investing with confidence. Thanks for listening, and here's to building a future where your money works as hard as you do.